Yeah, yeah. It's the repo market, reverse repo, actually, but I talk
Yeah,
about
sorry.
repo. It's a facility of the central bank in America, uh, and it basically is a facility that banks and other financial institutions can park their cash. And as we all know, there is excess cash at the moment in the market. The market is full of cash. In fact, um, everybody will recognize the big problem that we have right now in financial markets. It's a problem for institutional investors and also for retail investors. What should you do with your money? Um, I mean, if you already have like 2 or 3 or 10 houses, a good equity investment, some stocks, maybe the 25-25 portfolio that Willem has been talking about, then what do you do? Uh, you buy maybe some gold. You buy some Bitcoin. What else? What else? Where do you go? And especially if you live in Europe with a zero or even negative interest rates, putting it on a bank is not very wise. I mean, in the Netherlands, you get negative interest rates as a retail investor on accounts. I think it's 25,000. Everything above that is negative interest rates. So um, that problem is also present with financial institutions. They have a cash balance at the end of the day, so they have investments that mature that will bring money on the account. They'll do investments. That releases them of some of the cash. They have deposits of clients and clients taking the money off the accounts. But at the end of the day, they could have like a couple of billion in excess cash that they have to park somewhere. And normally, in a normally functioning market, they would park that at another bank. And they get some interest on that. Um, um, but if they don't trust each other, the banks, and if there's no other investment that makes any yield at all, and they're basically in the situation I described, they can now park their excess cash with the Federal Reserve. They get treasuries as a collateral for that overnight loan, and so it's very safe. It has minimal capital requirements, and it's obviously very beneficial. But the strange thing, of course, is that there's at the moment $1 trillion parked at this facility, and that's more than we've ever seen before. And it's a sign. It's like the credit default swaps in the 2008. It's it's a sign, yeah, like a canary in a coal mine that something is really wrong. Um, and Yeah, I think something is really wrong. Um, it, it 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 is strange that the central bank, the Fed, i- um, is actively doing a quantitative easing. So it's buying treasuries, bonds, equities, everything with freshly created money. So it's providing that cash to the market actively, and then the market is filled with excess cash, and then it has a facility to take that excess cash off the market again. Why not stop QE then? you, you know, that would be the same. You could just sell the treasuries again. You could do tapering, but we all know what happens then, and and you know it has a huge impact on interest rates. All this, they don't want the U.S. curve to go down. They don't want to go. They don't want the U.S. interest rate curve to go negative like it is in Germany, but they also don't want the interest rate to go positive, because if interest rates go back to normal levels, 3%, 4%, this whole system explodes because nobody can pay that load. So it's very interesting, and I advise people to watch it like a hawk. What happens there? And I see it together with the balance sheets of the central banks as the same as a warning signal as the credit default swap spreads in 2008.